Ever wondered how the current state of the Asian stock market is affecting global finance? Let's dive into the details. The Asian stock market, which includes major players like Japan's Nikkei, Australia's stocks, South Korea's Kospi, and Taiwan's benchmark, has seen a significant downturn recently. This downturn is not an isolated incident, but a result of multiple factors coming into play. First off, the tech-heavy indexes have taken a considerable hit as bond yields spike. Higher bond yields, particularly in U.S. Treasuries, have raised the potential for increased U.S. interest rates. As a result, investors are now seeking higher returns in the bond market, leading to a decrease in demand for tech stocks. Next up, the financial world is eagerly waiting for Federal Reserve Chair Jerome Powell's speech. This anticipation has caused an air of uncertainty in the market, which in turn has influenced the decline in Asian stocks. The Federal Reserve's plans to keep interest rates higher for an extended period have exacerbated the situation. Furthermore, geopolitical tensions are adding fuel to the fire. The escalating Israel-Hamas conflict and its potential spillover into other Middle Eastern countries have weighed heavily on market sentiment. Finally, let's not forget about the situation in China's property sector. Anxiety is mounting as major developer country Garden seems to have missed a payment on its offshore bonds, sparking concerns about a major default. In a nutshell, it's a stormy weather in the Asian markets right now. The surge in bond yields, tech sector losses, geopolitical tensions, and concerns over China's property market have combined to create a storm of uncertainty in the Asian markets. Let's take a step back and look at the events that led to this decline. We begin our journey with a global bond market rout. This rout, essentially a sell-off of bonds, caused a spike in yields. For those unacquainted with the term, a bond yield is the return an investor realizes on a bond. As bond yields rise, they become more attractive to investors, pulling funds away from the equity market. This is especially true for technology-heavy indexes, which are more sensitive to interest rate changes. This situation was further exacerbated by the Federal Reserve's plan to keep interest rates higher for an extended period. The announcement from the Federal Reserve had a particularly profound impact on Wall Street, where technology stocks felt the pressure. The prospect of higher interest rates can often lead to a sell-off in equities as investors shift towards bonds for safer returns. Now, we must not overlook the geopolitical tensions that were brewing during this period. The escalation of the Israel-Hamas conflict raised concerns about a potential spillover into other Middle Eastern countries. A deadly strike on a Gaza hospital only intensified these concerns, further dampening market sentiment. Then came the anxiety surrounding China's property market. Country Garden, a major player in China's property sector, appeared to miss a payment on its offshore bonds, sparking fears of a potential default. This sent shockwaves through the market, adding to the already prevalent uncertainties. Finally, the Asian tech sector, a significant component of the Asian markets, took a hit. The surge in bond yields, particularly in U.S. Treasuries, played a pivotal role here. Higher yields raised the potential for increased U.S. interest rates, causing investors to seek higher returns in the bond market. This shift in investor preference left the tech sector in a downturn, contributing to the overall decline in the Asian stock market. These events, from the global bond market rout to the concerns around China's property market, coupled with geopolitical tensions and the Federal Reserve's stance on interest rates, created a perfect storm. These elements, working in unison, led to a significant slide in the Asian stock market. How has this affected Wall Street, you may ask? Well, the reverberations from the Asian markets have certainly been felt across the Pacific, with Wall Street bearing the brunt of the impact. The tech sector in particular has been under immense pressure due to a global bond market rout, fueled by the Federal Reserve's plans to keep interest rates higher for an extended period. Speaking of tech stocks, Nvidia, a prominent player in the sector, faced significant headwinds. The company's shares fell by a considerable 4% as it warned about tighter U.S. export restrictions on its chips to China. This development could potentially impact the company's product development and customer support, further adding to the downward pressure on its stock price. But it's not just the tech stocks feeling the heat. The rise in Treasury yields has been another significant factor influencing Wall Street. The 10-year Treasury yield, for instance, soared to over 4.9% for the first time since 2007. This surge has led investors to seek higher returns in the bond market, further contributing to the stock market's decline. And let's not forget about the big guns on Wall Street, the banks. Morgan Stanley, for instance, reported quarterly results that beat Wall Street estimates. But before you start celebrating, it's worth noting that its wealth management and investment banking divisions underperformed. This underperformance led to a more than 6% drop in its shares, with investment banking revenue falling by 27% and wealth management revenue increasing by a mere 5%. So you see, the ripple effects of the Asian market's decline are far-reaching, influencing not just the tech sector, but also the banking industry and the bond market. Wall Street has certainly felt the impact of the Asian market's decline. What can we expect for the future in light of these events? As we look ahead, we're likely to see a number of potential outcomes based on the current events unfolding in the Asian stock market and their ripple effects worldwide. The surge in bond yields, particularly in U.S. Treasuries, is one key factor that could shift the landscape. Higher yields raise the potential for increased U.S. interest rates, a scenario that could see investors seeking higher returns in the bond market and leading to a further downturn in tech-heavy indexes. Moreover, the geopolitical tensions in the Middle East and their potential escalation could add another layer of uncertainty to the global financial landscape. The Israel-Hamas conflict, if it spills over into other Middle Eastern countries, could significantly impact market sentiment and investor confidence. The anxiety regarding a major default in China's property sector is another serious concern. The situation with developer Country Garden, for instance, missing a payment on its offshore bonds, could potentially trigger a cascade of defaults, shaking the very foundations of the world's second-largest economy. This, in turn, would have far-reaching implications for global finance. On Wall Street, we might see a continuation of the pressure on tech stocks. Companies like Nvidia could face further challenges, especially if U.S. export restrictions on chips to China tighten, potentially impacting product development and customer support. This could lead to a domino effect, with other tech companies also feeling the pinch. The Federal Reserve's stance on interest rates will also be a significant determinant of what lies ahead. If the Fed maintains higher interest rates for an extended period to control inflation, as indicated by New York Federal Reserve President John Williams, we might witness a shift in investment strategies and market dynamics. In conclusion, the future of the global financial landscape is teetering on the edge of uncertainty, with several potential outcomes hinging on various geopolitical and economic factors. As always, the market is a complex web of interconnected events and influences, and it's this intricate dance that keeps us all on our toes. Only time will reveal the true impact of these events on the global financial landscape. To recap what we've discussed today, the Asian stock market has been experiencing a significant downturn due to a combination of factors. Tech-heavy indexes bore the brunt of the impact as bond yields spiked, leading investors to seek higher returns in the bond market. A key event contributing to this decline was the anticipation of a speech from Federal Reserve Chair Jerome Powell, which added to the market's uncertainty. Additionally, the geopolitical tension caused by the Israel-Hamas conflict and anxieties over a potential major default in China's property sector further weighed on the market sentiment. Wall Street wasn't spared from this downturn either. The weakness in the stock market was partly influenced by a rout in the global bond market, with tech stocks experiencing significant pressure. Looking ahead, the future of the Asian stock market will depend on a variety of factors, including the trajectory of bond yields, geopolitical developments, and the health of China's property market. Keep these points in mind as we continue to watch the unfolding situation in the Asian stock market.